Over the course of 516 days, Russia has faced a series of sanctions from various nations, but recent ones have struck harder than ever before. The big question is whether these sanctions are genuinely achieving their intended goals. One objective of these sanctions is to change Russia's policy behavior, but the results have been mixed. The ongoing war in Ukraine persists, and the Russian government remains persistent. Nevertheless, the sanctions have undeniably put pressure on the Russian economy, leading to a 2% contraction last year. A critical aspect of the sanctions revolves around excluding Russian banks from the SWIFT payment system, impacting international transactions. Despite this, Russia still maintains trade ties with major economies like India, China, and Brazil. If these specific sanctions were lifted by the EU or other Western governments, it could facilitate smoother global trade. Sanctions are a tricky tool in the world of international relations. Some people argue that they might end up unintentionally hurting everyday people and businesses in a country, rather than just the government they are meant to target. Now, this raises another question. Do targeted sanctions work better? Targeted sanctions are meant to influence a country's policies, but they don't always succeed. In the past, countries like Iran, Iraq, and Cuba have faced such sanctions, but they didn't always lead to significant changes in policy. The sanctions imposed by the European Union caused Russia to lose its largest market, Europe. Now it relies heavily on China and India for sales. This shift has created new challenges, as Russia needs to offer discounts to persuade these countries to purchase its oil. Despite Russia's attempts to limit information to the West, the Russian Ministry of Finance has still been sharing some key figures about their economy. Now, with the data for June 2023, we have a clear picture of the economy's performance in the first half of the year. So, let's take a closer look at how these sanctions are affecting Russia's economy. We'll examine the impact on their earnings from oil, gas, and other sources. Additionally, we'll check their expenses and overall financial deficit. Furthermore, we'll delve into the state of Russia's reserves and national wealth fund. This will give us a comprehensive understanding of how these measures are influencing the country's financial health. So, let's dive into the data and explore the situation together. Strategic sanctions aimed at limiting Russia's resources have hit the nation's economy with relentless force, mainly targeting the energy sector. This has caused significant problems for Russia's financial stability and the balance of money flowing in and out of the country. The value of their currency, the ruble, which used to be stable, is now weakening due to lower tax income and dwindling savings. Investors are uncertain about the future of their investments in a nation facing financial difficulties. Over the past year, the Russian ruble showed unexpected strength after reaching a record low due to the invasion of Ukraine. However, in recent months, it has been steadily losing value and is now at its lowest in 8 years. Various measures were attempted to help the ruble. Still, its decline continued due to falling oil and gas prices and shrinking foreign currency reserves, which put more pressure on the ruble. One attempt that significantly affected the ruble's decline was an attempted coup by the Wagner Group. As a result, many people rushed to convert their savings into foreign currency, fearing further depreciation. The Russian government could have intervened to stop the fall, but it appeared to be reluctant, considering their budget revenues primarily come from exports in foreign currency. This created political instability within Russia and made investors nervous, causing a sharp drop in the ruble's value. While the ruble's decline may not directly affect Russia's ability to wage war due to its domestic arms production and reserves, it does mean that the country has less buying power. This could make it harder for them to fund the ongoing war in Ukraine. Moreover, the falling ruble might also lead to inflation, which can harm the economy and make life more difficult for the people in Russia. Before we delve into the energy sector figures, let's set the stage. Oil and gas revenues have historically been the backbone of the Russian economy. In June 2023, Russia's oil and gas revenue was a mere 3.4 billion rubles. compared to the robust 6.4 billion rubles earned in June 2022, representing a staggering fall of around 47% for the month alone. However, the real concern lies in the cumulative figures for the first 6 months of 2023, where the total revenue from oil and gas sales was just 11.5 billion rubles, compared to the significant 22.4 billion rubles recorded in the same period in 2022, translating to a massive reduction of over 48%. Surprisingly, non-oil and gas revenues have shown an unexplained and remarkable increase in 2023. In January, non-oil and gas revenue was 931 million rubles, but by June, it reached a staggering 9 billion rubles. The cumulative figures for the first 6 months of 2023 indicate that Russia recorded non-oil and gas revenue of 28.7 trillion rubles, compared to 27.2 trillion rubles in the same period in 2022, signifying an increase of almost 1.5 trillion rubles, or approximately 5.4%. Investigating Russia's expenses, we noticed a concerning trend of a month-on-month increase in 2023. In June 2023, total expenditure reached just under 15 billion rubles, compared to 12.5 billion rubles in June 2022, representing a significant increase of approximately 20%. The cumulative figures for the first 6 months of 2023 show that Russia has spent around 55.4 billion rubles, compared to 43.2 billion rubles in the same period in 2022, implying an increase of 12.1 billion rubles, or approximately 28%. The National Wealth Fund is Russia's financial safety net, holding reserves to cover international debt burdens and fund budget shortfalls. Over the years, the fund has fluctuated, but the significant increase in 2021 raised eyebrows. As of January 2023, the fund stands at $148 billion, accounting for approximately 8% of the GDP. However, with the ongoing losses and deficits, Russia has been drawing heavily from this reserve, raising concerns about its sustainability. In response to the crisis, Russia has launched a daring currency offensive like never before, urging nations to abandon the dollar. However, this remains a distant dream in a world cautious of risks. The data clearly indicates that Russia is facing significant challenges due to the sanctions and the decline in oil and gas revenues. Non-oil and gas revenues, while showing an unusual increase, do not fully offset the losses in the oil and gas sector. As a result, Russia's economy has recorded consecutive monthly deficits, drawing heavily from its reserves. Russia is spending a lot of money, which could slow down the development of the country for many years. The situation is concerning, and the war's failure has revealed weaknesses in their military and hurt their economy badly. Some people even say Russia is now too dependent on selling raw materials to China. If the current trends persist, Russia may exhaust its cash reserves over the next 3 to 6 months, which could have severe consequences for the country's economic stability and ability to sustain its war effort in Ukraine. The Russian economy faces an uncertain future as the world watches and sanctions continue. I hope you found this video informative and thought-provoking. If you did, please give it a thumbs up and share it with others who might be interested. And don't forget to subscribe to our channel for more insightful content. Thanks for watching, and I'll see you in the next video.